Investor interest in private debt has been growing steadily over the past decade, and a liquidity crunch caused by high interest rates and a pullback in lending by some banks is driving up demand further. But a new report by alternative investment management firm Ninepoint Partners says Canadian investors are not taking advantage of this asset class. For more details, joining us now is John Wilson, co-CEO and managing partner at Ninepoint Partners. Thanks so much for coming in today. We appreciate it.
Great to be here.
So when we're talking about private debt and what your company does, can you just give us a quick breakdown of how it's different?
Oh, thank you, Jacqueline. So as you know, Ninepoint's one of the largest alternative investment firms in the country, and we do a broad range of products, actually, beyond just private credit.
Sure.
But one of the key strategies in the alternative universe is private credit. And our team actually pioneered bringing those types of strategies to accredited investors in this country way back in 2010. So we've been doing it for a long time. And, you know, a big part of being in that marketplace in this country is about educating investors. Canada historically has not had access to a lot of these strategies that other developed markets have had. So, you know, introducing these types of strategies, educating people about them, making them more familiar with how they work and what kind of benefits they can offer to portfolios, which is considerable, is a really important part of what we do.
So investors would be investing in your funds, and that money would then get loaned out to businesses and whatnot who wanted access to that credit.
Sure, like if you're
talking about the private credit part.
Yeah. So the borrowers in this case tend to be small, medium-sized businesses.
Yeah.
They often are not eligible to go to the banks to get the to meet the banking lending requirements, and that's only because their businesses are often a little more complicated. They don't have the sort of rigorous reporting that a larger public company might have, and so the type of work that has to go into doing these types of loans is considerable. The loans tend to be more complex. You need to get collateral, even private and personal collateral. So the deals can be just more customized in the private lending environment. And what's happened is borrowers have really taken to it, and investors have benefited from actually putting their capital into those types of investments.
And the environment that we're in right now, we've talked a lot about the uncertainty in the financial sector in the U.S., and that, shook things a bit. And there was a pullback in lending because of that in the U.S. in particular. Are you seeing that change the game here? Because I saw that you described this as sort of a golden moment for private debt.
Yeah, you're right. We do think it's a golden moment globally, but also in Canada. So, what you have is really two things that are happening that are really, really important for the private credit space. First, you have some of the most sophisticated investors in this country have been steadily increasing their allocations to private credit. Think of investors like Canadian Pension Plan or Brookfield. And the reason they're doing that is because they can see the considerable benefits they get from diversifying into this really attractive risk-adjusted return that's not correlated with a lot of their other investments. So that's number one. Number two, as interest rates have gotten higher, it has created a credit crunch. So banks are less willing to lend. The kind of borrower that can meet their, the bar goes higher, harder to meet that bar. Mm-hmm. And so we're finding a lot of deal flow that would traditionally have been served by banks is coming down to private credit, which is growing the opportunity.
When you're thinking about it from the investment side of things, your sort of retail investor, if they were wanting to be involved in something like this, is this kind of like a GIC where you're agreeing to sort of lock in your money for a certain amount of time, or how does that work?
Well, first, these types of products are only available through an advisor. You have to be an accredited investor, which means you have to meet certain minimum wealth and liquidity requirements.
Okay.
But you're investing in a private asset class. So the trade-off, historically, if you look at how these investments have done, we run a fund with a partner called Third Eye. That fund, that strategy over the last 15 years has returned something like 10.4% per year. That's a really attractive return. But the trade-off is it's not liquid, right? You're making private loans to private businesses. You could buy Microsoft this afternoon at 10 to 4 and sell it again at 5 to 4. You can't do that when you're invested in private loans. So the money tends to be locked up for a period of time. There's significant notice requirements. There's limits on how much liquidity can exit the fund at any given point in time. And that's all done to protect, the other investors that want to stay in the fund.
Last year, there was a freeze to some of your funds in terms of wanting to get that money out. How did that play out? I mean, it sounds like that would be an expectation for some, but was it the expectation for all that you weren't able to access your money?
Well, I think, when we went through that period, what we did is restructured the funds. We spoke with all our investors, and the vast majority of our investors have been in this asset class for a long time and want to stay in this asset class for a long time. And they really pushed us to put limits as to how much could come out in any given quarter, because what they want is these funds to keep doing what they've done, which is drive really, really attractive returns for them over a long period of time.
Was there any sort of, reaction or fallout to that, though, in terms of, investor interest? If there is a possibility that, things get, frozen in the way that they did that change things at all in terms of conversations? Or?
I think the industry's gone through a lot of scrutiny over the last year or two, but in the end, we always focus on the same three things, which is, we've been doing this for a long time, longer than anyone else in the retail market in Canada. Number two, our investors have benefited from those returns over a very long period of time, steady, attractive, risk-adjusted returns. And number three, we've always had a culture of what we'll call compliance and excellence, right? A lot of integrity, a lot of focus on how we deliver those types of products, and trying to give investors as much transparency as we can, right? These are liquid private loans. It's not like, again, owning Microsoft where you get a 10Q every quarter. But we can give people more transparency into what they own and why they own it, and what some of the hurdles are in terms of when liquidity is going to develop. And I think that's really helped. What
do you see as the sort of appetite for borrowing as we go forward into this time where there could potentially be a recession? Do you think that we're going to see businesses pull back on borrowing in particular?
I think to the degree some businesses pull back on borrowing, there'll be many more businesses that won't have access to the borrowing they traditionally thought they might get. So overall, we think the market for private debt lending is going to grow. It's important to keep in mind the type of private debt lending we do is senior, which means you're top of the stack when you get paid back. So that's the safest kind of lending. The history has been in that type of lending that capital gets protected, gets returned to investors, and they get those attractive returns.